So at the moment, the S&P 500 is at all-time highs, actually surpassing the all-time highs set just a few months ago back in February. However, when you look at your account, if you're investing into the S&P 500, or maybe you're just invested into bog standard index funds, your account isn't at all-time highs, at least if you're a UK investor. So I want to just quickly explain what's going on, why things have looked this way at the moment, and actually there's a positive outcome to this too, which I'll explain in the video. Okay, firstly, let's just get on the right page here. As you can see, I've got the S&P 500 up, at least when you go on Google, and you can have a look here, and you can see that back in February, it was around 6,129, and at the moment, it's at all-time highs, just over 6,200 at the time of recording this video. But as usual, anything can change. Now, this is all well and good, but as you invest, as a UK investor, the elephant in the room is the exchange rate, which many of you may have cottoned onto already. So let me just compare a second graph for you just up here. On screen now, I've got two different S&P 500 index funds. I've effectively got one from the US and one from the UK. The blue line here is the S&P 500 index fund, which is traded as VOO, which is a really, really popular one. Lots of people also call it VOO. And the yellow line here is a really popular Vanguard one, which we can actually buy here in the UK, VUSA. Many of you will know it's a very popular one. Now just have a look at this. Over the past year, the blue line, which is the US fund, has done 13.32%. Yet this poor yellow line down here has only done 4.11%. If we go over a slightly longer time period, you can see how this does add up, and it is actually a little bit concerning. Let's have a look here. 5 years, for example, the blue line, our American fund, has done 98%. Yet from a UK investing standpoint, we've only done 79.5%. Now, all of this is to do with the exchange rate. As the pound and the dollar fluctuates, we're either going to buy more or less of our investments, and also our investments are either going to be worth more or worth less. You can just have a look on this graph, for example, where actually the blue line hasn't always been above the yellow line. So for example, just have a look here in 2022, when the stock market was having a pretty bad year. At one point, actually, the S&P 500 from America was only up 14%, but the UK one that we can buy was up 31%. So this doesn't always go in one direction, and is actually one of the part of the story that I wanted to explain during this video, because I think many people are worrying, just when we go back to this 1 year graph here, well, if I'm only getting 4% when the stock market's at an all-time high, am I doing something wrong, and what's going on? But let me just show you very quickly what's happening exactly to this exchange rate. So right now here on screen is the pound to the US dollar exchange rate. And if I just extend it out to 1 year, you can see what's happened, and you can see the acceleration. Now, you might not think that 1.27 to 1.3 something is a big difference, but actually it is. So for example, let me just take 1.26 here in July 2024, expand that out to today, and we get all the way to 8.62% difference. So the pound has got 8% stronger against the dollar. Now, this is both a good and a bad thing, but it depends what you're trying to do. If you're going to go on holiday in the States, like I am in a few weeks' time, then you're going to get more dollars for your pounds. So it's going to be cheaper for you to effectively buy things. However, when it comes to your investments denominated in dollars, trying to see the value of them, then you're going to get less, because effectively the pound is stronger against the dollar. So this is a bad thing. So effectively, it's a bad thing for people who are trying to sell their assets, which is why you see the value in your account. But I think here's the positive thing. And really, it's about saying, well, when you're buying investments, just like you're buying travel money, you're going to get more for your money. So what I would say to people at the moment is, the way I look at things is, if you're buying into the S&P 500, or I guess buying really any US denominated stocks, even though you have to use your pounds at some point, you are going to get stung with some kind of exchange rate at any point. At the moment, I think people really should look at this as a bit of a discount. So any money you're putting into the market at the moment, you should be a bit over the moon. Now, loads of people are always nervous about investing into all-time highs, and they always think, well, a crash must be coming and they better hold off loads of cash. Well, for UK investors, if you're one of those people that try and time the market all the time, this should be a time where you're rubbing your hands together, because effectively you're buying all of the same companies at a massive discount at the moment. Now, obviously, we don't know what the exchange rate is actually going to be in the future, and we can try and play this game as long as we want. However, there's not really many ways we can escape it. Now, many of you will be saying, okay, well, you can technically buy index funds which are hedged against the dollar to kind of remove this effect. But let me just show you this now in practice. And also, I want to kind of go through a bit of a pitfall about going things this way. So this is an example of an index fund following the S&P 500. I believe it's the most popular one or the one with the most money in it, which is actually a hedged index fund. Goes by GSPX. Now this is in this blue line here, and if you compare it to the Vanguard S&P 500 fund, which isn't a hedged investment, over the past year, you would have seen, wow, you're up 12% on your hedged investment, but your Vanguard fund in the UK is only up 4%. Now, you could quite happily invest into a hedged fund, but I personally think the downsides are bigger than the potential upsides. With a hedged fund, you're effectively betting one way in one direction, when actually we could be sat here now saying, well, my Vanguard fund in the UK that isn't hedged could be up 15 or 20%, for example. By hedging, you're effectively placing a bet that you're trying to remove that element of the exchange rate, if that kind of makes sense. And personally, I like to step away from that. Now, another reason I don't really want to hedge, or I don't pay too much attention to exchange rates, is also because think about yourself as a long-term investor, right? You're investing regularly, like many of you are, for your pensions or into ISAs every single month. Now, every single month, you're either going to get a good exchange rate or you're going to get a bad exchange rate. Nobody can know next week, next month, next year what exchange rate you're going to get. And likewise, if, for example, you're doing all of this investment for retirement or some kind of financial freedom, let's say in 10, 20, 30 years' time, you want to start selling your investments and withdrawing down from that investment, you're also going to do it gradually. You're going to do it at a point where the exchange rate might be like it is now. It might be not be a very good thing. It might also be the other way. So over time, as you put money in and can effectively dollar cost average and dollar cost average out, I would expect you to get some kind of average price. Sometimes it'll be good, sometimes bad. So for example, 1 month you might want to withdraw £1,000 of your investments, and 3 months later, the same £1,000 might cost you less because of the way the exchange rates are working. Now, that just might be the case as it is. There's no way though to predict that. Now, I think that's a key part of this video. Although it's good to understand what's going on in the market, and we can have a look at these different exchange rates and understand there's not a huge amount we can actually do, I think taking action and changing your investments because of what you know now really is the bad thing, and the thing that you shouldn't really do, at least something that I totally avoid altogether. And I think it's another stress that I just don't worry about looking at. It's good to know what's going on, but changing your investments because of it, I personally think is a very bad decision. A final point I'd make is this one. I think it's another good lesson to actually just be well diversified when it comes to your investing. The downside about investing, if, for example, you were wholly into the S&P 500 as a UK investor, is that you're getting massive exposure to the US dollar and the relationship between the US dollar and the pound. Whereas if you were more invested, for example, in a global fund, yes, you still have a very large chunk exposed to the dollar, but also there's other currencies out there around the world, the euro, the yen, for example, that are also going to fluctuate on that open market. And because we don't know the future, personally, again, I would rather be well diversified, exposed to lots of different currencies, because really there's not so much we can do. At the end of the day, the UK pound isn't the global reserve currency, and there's only so much we can control. We can't control what market traders want to do at any single time. So there's the really important message. And I think the key takeaway is if you're a long-term investor, none of this really matters. And if anything, it's a discount, really. You're going to get more for your money as someone who is buying. Yes, it's not as good when you're selling. So pros and cons, but as most of you out there who are watching my channel trying to build your wealth, this is a great chance to effectively get more of the same investments for less money. Hope you've enjoyed the video. I'll see you in the next video. Happy investing.